You're welcome to the final Present analysis class. Today, we are going to round up on this analysis towards getting you ready for your exams. We already started last week, gave you a report last week. So today, we're going to review that report together with another variation of that report, particularly regarding the strategic direction of the company. Just for us to prepare that in whatever way ICAN wants to come up with their own thing, we want to be ready. Remember that this is a 4 hours exam, 1 hour for you to read and plan your answer. It is during this 1 hour, you're expected to properly read the unseen and understand the requirements and know what exactly appendix you're supposed to calculate. And with your appendix, you should then be able to approach your answers based on the requirements in the first exhibit. This I'm in class. Now, remember that the name of the company in question is Sado, and the company is into cocoa processing. And this company has a series of challenges, and also there are opportunities that are untapped in the industry where this company operates. Before we moved into the industry, it gave us an idea into the cocoa business in Nigeria from the golden era to the challenges era, which is the 1980 to 2000, to the period where the company or where the industry is now striving for survival, which is from 2000 to date. There are a series of opportunities that have been identified for growth for this industry, and which would typically happen by adopting modern farming techniques, expanding value-added processing, strengthening farmer cooperatives, promoting sustainability practices, attracting foreign investment, exploring new export markets, improving infrastructure, particularly in rural areas. For us to enjoy the gain of this sector, all these has to be in place. For us to realize the opportunities, they have to be in place. With that understanding, we saw that in Nigeria, the capacity is there, but we have not been able to tap fully or fully utilized the capacity of this sector because of series of challenges. So challenges that includes rising global demand for cocoa, particularly in emerging markets, potential to increase the challenges. So the challenges there are majorly their struggle to source enough high quality beans due to competition from exporters and also logistical hurdles. Unreliable electricity supply is also a persistent problem. Also is raising production costs, which is causing operational disruption, poor transportational infrastructure, which is increasing the cost and delays delivery of both raw beans and processed products. Also is limited access to affordable financing that's affecting investment in technology upgrade and capital and capacity expansion. And also there is the competition from more advanced countries like Ivory Coast and Ghana, and also its policy inconsistency and unstable regulation that create uncertainty that also discourages further investment in the sector. So from the Nigerian perspective again, these are the challenges that are facing this sector. It has huge opportunities. Before we can get the gains of those opportunities, we have seen that we need to modernize our equipment. We need to improve our infrastructure. We need to have access to finance. So the flip side of that are obviously the challenges that has to be resolved. So that's at the country level. Now, to Sadeco, we're given their structure, the structure of their board, and we have been able to identify some challenges, some limitations that they have faced in terms of their board composition, and which we are going to recommend how to deal with that. And also, the company itself has challenge of lack of working capital, which is resulting in which is arising from delayed payment from customers, high interest rates, outdated plans, and all that. And the impact of those challenges, they have resulted in their inability to buy raw materials, and they cannot also pay their suppliers. And also, they cannot operate efficiently, right? So all these are challenges that arise from lack of working capital. Another challenge that this company face is international rejection of their products due to poor quality control, lack of certification, inadequate packaging, lack of market research, and this has resulted into loss of exports that has damaged their brand reputation. It has also increased costs associated with storage and the rest. How do they want to get out of this problem as an entity? One is financial restructuring and working capital management. So when we say financial restructuring, capital structure, and capital, whatever, it's just a big language. All we're doing, there are different ways in which you can restructure your capital. And one of the easiest ways is inject equity. Inject equity. So ICAN might not particularly be asking you about capital restructuring. It will just be part of the context. The best way to financial restructure is to inject money. Just inject money. Everything will structure itself. But other ways include trying to speak with their suppliers that they are owing money for a possible restructure of existing debts. Probably they will allow them to more time to pay and also help them reduce interest rate. And also for working capital management, instead of piling up inventory, why not wait until you get orders before you manufacture? Or you have a detailed financial plan you're working with. And also you can also apply for government grant. Those are ways they can manage their working capital and also restructure their capital. So look for capital, look for equity, or Go and get government grant. Also, to improve their quality and also certification. So what they need to do is implement a quality management system, have a procedure in place to ensure that your raw material sourcing is 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 from a reliable farmers. The packaging is done properly. The storage is at international standard, and just ensure that you implement the relevant ISO relating to food safety management system. You can also invest in up-to-date quality control equipment or train people, obtain relevant certification, or launch a supplier development program to work with farmers, offering them training on how to improve agricultural inputs to enhance the quality of cocoa beans and reduce contamination risk, and particularly upgrade packaging by investing in high quality materials. So these are ways in which these guys want to deal with each issue of quality so that the rejection of their product will be reduced drastically. There's also backward integration, whereby they will have to go to the farm themselves, buy farms, acquire farms themselves, or lease farms to ensure stable supply of high quality beans and lessen dependency on external suppliers. So this approach will require substantial capital, of course. But instead of going to buy, why not just they can partner with cocoa farmers through cooperative or outgrower schemes, providing them with training, inputs, and financial support in exchange for a consistent supply of quality beans. And they can also go into partnership with global manufacturers, global companies that can help them with FDIs, that can help them with modern equipment, that can help them with working capital, training, and all of that, which is the fourth one. All of this has a risk, and we have been told how we can mitigate against this risk. So the whole exam is all about how we can make all this possible, how we can make all of this possible. So last week, we were able to come up with an unseen, and the unseen is basically around the challenges that we have seen that this company is facing and how they want to resolve it. It's clear that as far as cocoa processing is concerned in Nigeria, one of the key issues that they face is lack of access to financing. It's clear, there's no doubt around that. Even if they get the finance, the interest rate is too high. It's a major issue. Beyond inability to get financing, is that they don't even have the equipment that they can use to work. Their equipment are out of date, and which is affecting the quality of their output. Not to mention even the quality of the input that they get from farmers. And they don't even have so much great relationship with farmers as they are also owing them. So beyond all of this is that at the macro level, there are serious issues. There is policy inconsistency. There is lack of the infrastructure is there that is not available. And I mean, to access capital is also very difficult. These are series of problems. At the micro level, at their own level, they have serious working capital issues, and they have issues around rejection of their products. They have serious problem. And we know their way out now. We have been told. Now, your responsibility in the exam is therefore to advise them. In fact, you will not advise them. Is they are going to tell you what they want to do. It is now left for you to look within the numbers, within what they want to do, and advise them whether is a viable option or not, and you then recommend a way forward for them. So one of the things they might tell you they want to do, they can't solely say they want to financial restructuring. That's just a process of what they would do. So the question will not be solely around this one. Is part of is something. This one is something they must do. You need to have money before you move to the next step. So this one is a given. This first one, again, you definitely is part of what has to happen, right? The quality improvement, this also has to happen. It's going to be there. This is not the destination. It's going to be included. They will spend money. There is nothing they want to do that they will not invest in getting certifications. They have to spend that money. That they will not invest in ensuring they have good quality management system. So this is is like a determined cost that has to be considered. Now, where the question is going to come from, which is the destination, is okay, with capital available, with quality management system available, okay, which approach should we use? Should we backward integrate, whereby we have money, we have raised money? So should we go and buy farms so that we can have steady supply of raw materials? So that the issue of quality raw materials and all that is completely eliminated. Or we can just, instead of buying farm, we can partner with farmers. We can do Agora scheme. We just train, we'll have farmers that we train, we'll give them financial support. And the first point when it comes to supply is us. They will supply us. So they own their farm. We just are off takers from them. That's one option that you have to deal with in the exam. They will give you numbers to that. You have to be able to assess whether it's going to be viable or not. The second option is strategic alliance. Instead of going backward integration, why not partner with an international company that has experience around manufacture of finished goods? Why don't we partner with those guys and continue to source material the way we source it? Let this guy bring in equipment, let him bring in money, let him bring in let him bring in his own technical expertise in quality control, in branding, in product development, in injection of working capital. Let him bring all that in. Then we can use that to channel our way forward. We looked at this option last week. That was the first report that I gave you last week. Now, today, I'll be giving you an additional report. That's the one that deal with backward integration. Well, okay, let's backward integrate. Let's take over the raw material sourcing ourselves. Let's take over that ecosystem. Let's take over that space and move forward from there. We're going to be looking at whether that option is also viable. That is where your question is going to come from with certainty, because the other strategic directions of raising capital, increasing or improving or enhancing quality, those has to happen. That is not where you're going. It has to happen. Then, importantly, you have to look for money, then decide what you want to do. Now, the Pusin gave us this company's financials. We discussed it, we analyzed it last week. We saw that the company is in a negative profitability position. We saw that his capital structure is also not so good in terms of their equity. Their equity is very, very small. And I mean, in the next year, it's surely going to be negative. If they move at the pace of losses at which they are moving year on year from 22 to 23, 24 will definitely be worse. They have huge trade payables. Their trade payables is even more than their equity. Huge borrowings. Their borrowings is even more than their equity. So it's a serious capital problem with this guy, that the only viable solution for them that must happen is not borrowing, but capital injection. That has to happen. So we are going to be speaking, the analysis will be from the standpoint of whoever wants to invest. When he brings his money, he needs to be sure that can this company turn around this money into a profitable venture? Yes, no doubt they can turn it around, right? But at the same time, we need to still look at the numbers and ensure that we're able to get something great out of it. So from all of this, we brought out a preseen and unseen. And the unseen dealt with writing an advocacy paper, writing a government, and advocating for inclusion of this industry, for expanding agricultural and agro-processing policies to support the cocoa processing industry. So we are supposed to identify the policy incentives that need to revive this sector by drawing their attention to those exhibit 2 and 3 in the present that shows us what we lack and what we need for the industry, or I think the industry to improve. Also, we're supposed to review financial statement for 2023 and 2024. We are also supposed to evaluate the proposed strategic alliances and also look into governance, ethics, and sustainability. So this was the first one that we looked at. And they also give us the draft 2024 financial statement of the company, though unaudited. But they gave us for 2024, they have given us 2022 and 2023 before. Expectedly, the figures are still looking southwards. They are looking not good. Negative equity, losses, huge liabilities, and all that. That the equity is now negative. They are just not looking good right now. They gave us issues, another exhibit dealing with the board structure, speaking to the people that are involved, the fact that there are no independent directors, family dominance, poor attendance, no audit committee, and also performance target is merely based on volume and with little attention to quality and sustainability practices. Also, internal audits made some findings around quality control, around supplier kickbacks, around inventory thefts, and document falsification. Also, they gave us issues around some adjustment that need to be made on impairment of PPE, also inventory obsolescence and impairment of receivables, and also some lawsuits that are in court right now. And our figures is not jiving with that of the bank. Current ratio, we cannot maintain the 1.0 as expected by the bank. We're currently doing 0.12. Debt to equity ratio of 2.0 can no longer be maintained as well. Staff morale is low. People are resigning, especially in the production department and also quality control department, which is affecting our critical pain points within the organization. The proposed strategic alliance is to align with an international company, right? And the way they want to come in is that the alliance would be, the guy is going to be bringing, they are going to be establishing a subsidiary. They are not giving us the money. It's not like they want to. So it's an alliance, it's a partnership. So we're going to be, they would incorporate a new company called Sado Choco Limited. So the aim is to move up the value chain and produce branded chocolates and to improve quality control to meet EU standards and also to access that international company's global distribution network. So the terms is that the multinational company will invest £2 million, approximately 1.2 billion, and they are ready to take 40%. They are bringing in technology, modern equipment, and machinery worth £1.5 million, and they would also provide technical expertise. Also, we are going to be providing space, workforce, and materials. We have an existing processing facility already, though underutilized. We are going to be getting 60%. The investor will get 40%. We're going to be giving them management fee of 5% of our revenue. They will also get royalty of 3% because we are going to be using their brand name. It's a 10-year agreement, renewable. They are also going to give us working capital that is coming directly to SCPL. And this is a projection for the new subsidiary that they are establishing. After all the materials for each year is in a profit position, but we're going to share the money 60-40 among one another. We are taking 60. But because we are going to be redirecting some of our raw materials that we use right now to this new venture, we are going to be losing 150 million naira in contribution. So that's what they call displacement effects or cannibalization effect. Also, we need to look for 340 million in addition to the 300 million we're going to get from Irochukwu. The board is expecting that from this alliance, we should be able to do a return of 20% in the first 5 years. We also got a letter from an importer abroad complaining about the quality of our products and the consequences it has had on them. The fact that we sent them product and it was rejected by EU, they have sent us some costs that we'll have to incur, totaling 324 million, like around 550 pounds. So they have advised us to confirm within 14 days how we intend to settle and also provide corrective action plans and all that. All this we read last week. Now, in our solution, I try to believe that you have all looked at. So the first step, go to the main report, is for you to go to your working straight up. You can write your cover form to like is in that report. Then the subject, then you go to your working straight up. After that, after your cover page, you start your appendix. So the first thing, the sequence with which the exhibits were given, there are some adjustments that I need to make from those appendices. First is impairment of PPA. I was told that they gave me this one. In the exam, they might not give you that. You might have to calculate the impairment yourself. An impairment is recoverable amount minus carrying amount. So where your carrying amount is higher than your recoverable amount, it shows that the asset has been impaired. There was a write-down of inventory. Also, there was an impairment of trade receivables. There was a lawsuit by a supplier and also by an EU importer. This is what they are claiming. So the impairment will affect our assets and also expense. The inventory will affect cost of sales and also inventory. The receivables will affect P&L and also the trade receivables. The provisions will affect P&L and also liability. The provisions or the claim from the EU importer will affect P&L and also provisions. So I used, based on the listing, the adjustment A, B, C, D, E. I just drew a table to adjust every item here. So the first adjustment, which is A, for my financials, that would affect P&L, okay, which affected my operating profit or loss. It went into my profits. It went into my profits. So it will be a deduction for my profits, the impairment loss. And also it will affect PPA. It will be deducted from PPA as well, which will also affect total assets, non-current asset and total assets. It will also affect retained earnings. This is coming from the other leg that affected your profits. It would also reduce your retained earnings as well. So eventually it reduces my total equity. All that I just the effects of adjusting P&L will affect retained earnings. The second adjustment was the inventory, which will affect my cost of sales, right? It's going to increase my cost of sales. So like adding it to existing cost of sales, which will also reduce my gross profit and all that, affect my retained earnings and the rest. It would also affect my inventory, okay, then total assets, then it has those trickle down effects. The same thing for the receivables. It affects P&L, impairment of receivables. It was 11,700 and it is C. So impairment of receivables, it will affect P&L, affect profits. It will also affect my trade receivables. Also is the provisions, the two provisions, they would affect P&L as well. The D and E affects P&L. This one affects P&L. The second one affects P&L. And they would also impact my liabilities under provisions. So provisions, so they increase my liabilities. So you don't necessarily have to draw up a table, but you will need to have an adjusted figures, because if you identify which items will be affected in the exam, would not strongly recommend that you might not necessarily have to prepare the whole statement. That would be a waste of time. So you can just identify what is going up. Like this one, this is going to affect your profits, right? So it's going to affect your profit, it's going to affect your total assets. This is going to affect your profit, it's going to affect your total asset, right? You might just increase those ones that you might need in calculating in doing your ratios in the exam, like that, because that will be faster for you, because you only have 1 hour to deal with your calculations, your appendix in the exam. You don't want to spend all the time adjusting financial statements. That's even if you're asked to do that. But there is high likelihood that you might have to do that. So this one also, it affects your profits. It will also affect your total assets. And of course, your equity will also increase because it's affecting profit. The same effects on this one. This will affect your profits, reducing your profits, reducing your equity, and increasing your liabilities. Also, the same effects with this. So with that, you would have an adjusted figures. And with those adjusted figures, you can then do your ratios. Everybody should be used to computing ratios. So what I did was, for my profitability ratios, I did just 3 ratios. At least best case, I did 3. Gross profit margin, operating profit margin, net profit margin. These will speak to my cost of sales. These will speak to my overheads. These will speak to my interest. And if I have the time, I can do OC. And there's no point dealing with OC because this guy is poor in terms of his capital structure right now. So I did 23, 24, and after the adjustment as well, everything is negative or true because it's in a negative profit position. in the exam, be that wise not to waste too much time on, don't solve, don't attempt so many ratios. No. So do your profitability ratios. You can do four if you wish.
Oh,
Your liquidity ratios, popularly, you would do current ratio, quick ratio, cash ratio. So while you're doing those three, because your current ratio speaks to the basic liquidity ratio, current over current asset. Quick ratio speaks to the fact that, yes, your current assets might just be a composition of inventory alone. So let's remove inventory and let's see where you are. You will see that when we adjusted in the adjusted account, his quick ratio is already in negative.
how about six?
His quick ratio is already in negative. And his cash ratio acknowledges the fact that this guy, does he have cash to settle his liabilities right now? So which is cash over current liabilities. So typically we would do these three ratios for liquidity ratios. Then do your efficiency ratios as well, like your inventory turnover, inventory in days, receivable turnover, receivable in days. Now, don't do all of this. I would recommend three also. All these turnover, you can leave them. Focus on the days, inventory in days, receivables in days, payables in days. And if you wish, you can do cash conversion cycle, because it's just receivable in days plus inventory in days minus payable in days. But I'm just giving you different options for you to use in the exam. So inventory turnover is cost of sales over inventory. The reciprocal of that is inventory in days multiplied by 365. So if you want to do inventory in days, you will do inventory over cost of sales times 365. Ignore this my formula. Although this is a sharp formula for you to really run through it, that we use. If I get my inventory turnover, if I do 365 divided by inventory turnover, it gives me the number of days. Because inventory turnover speaks to how many times it takes me to sell my inventory. How many times? That's what inventory turnover speaks to. Like this is 2.56 times in a year. So if I know how many times, I can know how many days it took me on and up by doing 365 over the turnover. So that gives me number of days. And number of days here is long. Though when we did some adjustments, it reduced, right? On the account, I'll be using this as a basis, really, after they have adjusted some inventories. The same thing for receivables. How long it took them to collect their receivables, then payables, how long it took them to pay. This is the one that would call your attention. How many days it took you to pay your your payables? It's taking almost 2 years, over 2 years, 660 something days. So that's the major problem around the working capital they have anyway. So they need money urgently. So this guy, they are having a negative cash operating cycle. Negative cash operating cycle. Even though negative should be good, because the lower the operating cycle, the better. But in this context, it's clear that this company has a problem. The reason why this is negative is because of the ridiculous number of days it takes them to pay their suppliers. They're in trouble. Is this efficiency wise, working capital wise, this ratio points to red. Solvency. There is debt to equity. There's even the critical one that you might also add, which is interest cover. Interest cover, which is PBIT over interest. Those two would just be fine for you. So I did debt to equity, debt to assets, equity to assets here, and all in negative, because this company is in a negative working capital situation. His solvency ratio is terribly bad. Working capital ratios, you might just leave this out in the exam, really. The only one you might want to do is this asset turnover, which is your revenue over total asset. So one thing you cannot run away from that is certain that you need to properly look at is the computation of these ratios. It's there for you. You have to do it in the exam. And when you do this, in your main body of your reports, if it's requirement 2, you will see those are requirement 2 and analyze it, comparing one year to the other and letting them know the impacts of those ratios. The ones that are not good, letting them know that this is bad and this is why. Stating all of carefully analyzing each categories of ratios. Now, the next appendix is the strategic alliance, the projects, the new company that we established with Euroshoko. So the project horizon is 5 years. I just summarized the key numbers. We are targeting 20% IRR. They use an exchange rate of 600, residual value 0. We are going to be having a share of 60%. We are going to be losing a contribution of 150 million. The guy is going to give us 300 million as working capital. We are going to be repaying back this working capital at the end of 5 years. So they gave us this. You won't have to, we do this, of course, in the exam, because all I need is just the profits. They already gave me in the question. The exhibits gave me already. So I need these profits just so that I can calculate my share. So based on my relationship or partnership with that company, this is the profit we are making. And this is my own share, 60% of this, which is 21.6 million, 60% of this, which is 50.4 million. That's the profit I'm making in year 1 and year 2 to 5. By the time I remove the displacement effects, which is the contribution I will lose, I'm having a negative cash flow. That shows that it's not variable. Probably maybe in the exam, the cash flows might be different and it will show that it's good. But what you're learning here is just the sequencing of your calculations. Here is showing that it's bad. Noting that I will still need to invest, though I'm getting working capital from him. So from all of this, I need to know whether this project is viable or not. In year 0, I will need to invest, and I'm getting working capital from Euroshoko. So it's a net cash outflow. Unfortunately, the other years is a negative cash flows. Incremental cash flow was negative. And at the end of the 5th year, I will need to pay back that working capital. Okay, this might be different from what you learned in SFM in terms of working capital, because the working capital you learn in SFM, you are the one injecting the money. You are the one, it's like an investment for you at the beginning, and at the end, you are getting it back. But in this case, you are collecting, somebody is giving you working capital. It's like a loan. So it's an inflow for you at the beginning in this context, and at the end, you're paying back. So net cash flows, NPV, this is the net cash flows. If I discount those cash flows to present value, I'll be having a negative NPV. When you have a negative NPV, that's bad. That's where the project is not viable. The IRR they are talking about 20% will not be met. So speaking, as soon as you see a negative NPV, it shows automatically that we should not even, we will not even bother. Okay, Pelumi, yeah, I can see your hands, please. Go
Yeah, I
ahead.
thought for IRR, we needed to compute 2 NPVs, one that will give us positive and one that will give us negative, with we would be the one to assume a discount rate, something.
Yes, I know. So I don't want to follow that route for us here.
Okay.
Yes, I don't want to follow that route here, even though they might be. So for us, we are doing more of analysis. The ultimate determination is the NPV. When the NPV is negative, the project will not be viable. Additionally, if you want to consider your internal rate of return, your IRR, and you know that in this case, this guy is looking at an IRR of 20%, right? And with 20%, IRR is the rate that makes your NPV to be zero. IRR is like the minimum viable return that you would expect. Okay, so looking at IRR of 20%, we tell them they can't get it. Now, if you want to consider further, like other ones that we're going to do, if this was positive, then we can estimate. What we're going to do is to estimate a range. What we're going to do is we're going to estimate a range that IRR is going to be between this range and this other range. We're going to look at that in the next variation that will show you very soon. But if you want to test for IRR, the lower the discount rates, if you use a lower discount rate, you would expect your NPV to be higher. You expect your NPV, the value of your NPV to be high. So in this case now, the IRR this guy would have to get will be very high. So yeah, I was not computing because I don't have that time. So I just did, okay, if I do my NPV at 0%, meaning if this discount factor is 0%, all this will be 1, 1, 1, 1, 1, 1, 1. So the PV will be these cash flows, right? It's still going to be a negative, and I will still be in negative. So if I increase it to 10%, let's say approximately the negative reduces. If I increase my rates, if I increase it to 30%, approximately it also continues. So before you can get to zero, you'll be looking at close to 100% before it can get to zero. So you will see a situation whereby my NPV is zero, where my NPV is positive, then I will use an higher rate, because when you use an higher rate, it brings your NPV, it brings it down close to zero. So with that, if I use an IRR, I can then estimate that approximately the IRR should be this. But this question is not about computer. They already told me that this company is targeting an IRR of 20%. That is what they are looking at. And all I will tell them is that you cannot, it is not going to work. At 20%, you're doing a negative NPV. And I'll tell them why. And I can estimate if an IRR in this case will be looking at close to 100% return. Another key one is sensitivity analysis that they might bring, they hardly, I really haven't seen much of it in your exam. So I just want to speak to it. So for sensitivity is that here, this project is a failure, no doubt, considering the numbers that we used. But we are saying that what if we vary the cash flows a little bit? What would be the reaction of the NPV? That's sensitivity. If we vary the cash flow, what would be the effect on NPV? So what I did is I reduced the displacement effect by 50%. It's still not viable because it's still negative cash flow. Still not going to be viable. Okay, let's assume we eliminate the displacement effect, meaning that contribution that we lost. Let's assume we did not lose it. Then it becomes viable. Then it becomes viable for us. So if we'll increase my this thing by, let's say, 30 to 35%, then I will be able to, that will be my IRR. So you could probably do an NPV just to confirm that if you increase it to 35%, NPV might turn negative or close to zero. Then this will be the recommended IRR for you. So what you're doing is that the higher the discount rate, the lower the NPV. So, and IRR is an NPV, is a rate that makes your NPV to be zero. Is the minimum return that you are ready to. So for this guy, the minimum return they should accept is 35%. That's if there is no displacement effects, if they are not diverting some of their raw materials into this new venture, they will need 35% return for it to be viable, minimum. So I also did payback period using the cash flow given. Of course, it's still negative since all the cash flows are negative anyway, because year zero cumulative 40K, another negative. So the negative continue to increase. So our payback period is not achieved within 5 years. So I have done my working. So then went to my main report to speak to it. And the way I did my main report, I went straight to I did my report, my main report based on the requirements of the question. So the first requirement was that I should do an advocacy paper extract soliciting government support for the cocoa processing industry. So, and the beauty of doing these reports, the beauty of doing this, of when you want to do a report, is your ability to properly subhead each component of your report. So, like, I start with an introduction. Usually my introduction will talk about what I want to do, what I want to talk about, what I'm trying to achieve in this report. So if you look at the way I wrote my introduction here, I said, this extract is prepared for inclusion in an advocacy paper to the federal government of Nigeria. It solicits the expansion of agricultural and agro-processing policies to support the cocoa processing industry, drawing on the historical significance, current challenges, and all that. So the cocoa processing industry has potential to become a major driver of economic diversification, job creation, what you can do. And if this is not done, if the government does not intervene, the sector will continue to underperform. So this is my introduction to what I want to talk about. The point I will later build in the main context, starting with the historical, to the challenges, to the incentive I want, and all of that. Okay, yeah, Palumi, I saw your hand, please. Go ahead.
Yeah, so I just wanted to follow the sequence of the we'll be answering this exam question because we'll be writing with our pen, right? And we are not typing.
Yes.
So we'll start with the cover page
Appendix.
from this person to this person. And then the
Yeah.
next thing will be our workings before we then head to the
Yes,
main report.
that's correct.
So where does appendix then come in? I thought the workings was supposed to be like our appendix or something.
Yes, now.
Okay, so all this
The,
first one, all these workings is the appendix.
that's correct.
Okay. And then we'll now go to the body of the main report. And
That's
after the
correct.
main report, we'll then do executive summary.
That's correct. And that's all.
Okay, thank you.
You're welcome.
Okay, hello. Sorry, I thought the executive summary is supposed to come at the top, normally for a write-up.
Yes, 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 yes. Yes, yes. So we have, yes, it should normally come at the top, but executive summary is a summary of your main findings and your recommendations. Your main findings, your recommendation and conclusion. There's no way you can know that in an exam until after your report. So, which is why we advised, you can leave space if you want, But the reality is that executive summary should be written last. You cannot write it first. You'll be writing what is wrong. How can you know your findings and recommendations when you have not written your reports? Ideally, is after you have written your report. In writing your executive summary, you'll probably be going into your report to be looking at, okay, what did I recommend in this part? What did I recommend in this part? Then you are mostly summarizing that in your executive summary. So yes, in a normal report, in real life, that's what comes first. In real life, yes. And in real life, we don't write it first. I would do my findings. I know exactly then, okay, just for the course, if I don't want my clients to go through the report, when they look at my executive summary, they should understand, okay. They should be able to know that, okay. They should understand the whole report. So which is why this you are writing, this is exam. I'm not copying and pasting, something like that. So practically, it's something you write last. So it's not your own decision in the exam, whether you want to put it first or put it last. It makes no difference to the examiner. It makes no difference to the examiner because even when they want to mark, that's the first place they will go to. They will look for your executive summary. We are not expecting to see it first. Maybe the cover page first, yeah? You're not expecting to see my executive summary first. If you are not convinced with what I'm saying, right, you can write it on your cover page and note that you can find my executive summary at the end of my whole report. If you think that will make you comfortable, but you definitely cannot write it first. Okay, I think we have settled that already. Any other clarifications? Okay, so I was
Yes,
talking
sir.
about
Yes, sir. Yes, sir. Hello,
okay,
sir.
yeah. Yes, BC, go ahead.
So I'm just trying to get what you said all over again. So we do our cover page first, then the appendixes, then the executive summary.
No, then the main reports, then
Okay.
the executive summary.
Okay. Cover page, appendices, main report, executive summary.
That's correct.
All right, sir. So again, I want to in the main report is where okay, so there is this strategy I read about where it says when answering case study question, we have to look for the requirements, the issue, analysis, implication, and recommendation. So this requirement, issue, analysis, implication, recommendation, am I going to apply it in my main report or my executive summary?
Your main reports, that's where you're writing, that's where you're analyzing what you have worked out in your appendix.
You 3,000 is not the problem. You are not
Thank
reading
you, sir.
Yeah.
But
Okay.
I can see it reading now. So if you know
Sam, you're muted. Oh. We can't hear you if you're talking.
Yeah. Thank you, Pelumi. So again, you structure your reports based on the requirements of the question. So I started with the first requirement of the question, the requirement 1, that talks about advocacy. And okay, so let me just attend to this last question so that I can run through the reports and move to, Aliwat.
Yes, good afternoon, sir.
Good
So I just
afternoon.
want a little more clarity. So you said ideally our executive summary should come at the end, and then you said first the cover page, then the appendix, then the main report, and then
Yeah.
the summary. So in a situation where you want to leave space and then come back to write your executive summary when you're done, what will be the structure? So you don't want it to be at the end, you want it to be at the beginning, but then you just leave the space, finish and come back.
Yeah.
So what would the arrangement be?
It will be after your cover.
All right,
So
okay, thank you.
yeah, it will be after your cover. But
All right,
the danger of that is if the space is not enough, voila. Okay. Yeah, let me take Amy. Beato.
Yeah, so the issue of your
executive summary coming before or coming after. The pages are detachable, and this is what I do. I start my workings from the last page, then I answer my questions from the beginning. So after answering the question, I go to the page where I worked on it, whether it's page 20, page 17, page 19. I detach that working and go and attach it with the answer I've done. So even if you write your executive summary wherever, but you want it to be in the front, you can still go and detach it and go and attach it to the front of after your cover page so that when the examiner opens it, you can see cover page and executive summary. Even though you've written your executive summary on probably on page 20 or page 19. I think that will clear up this back and forth so we can focus on the main thing.
Okay, I hope that helps some people as well. I hope that helps you. So, but if you don't still want to do that, I mean, it does not matter. I keep saying it. What more matters is properly headings should be properly presented. And you're in an exam, is the focus should not so much be about structure. The guy wants to mark main points. He wants to mark main points and he's going to mark everything in your handout. You need to focus. I don't know if you are focused on that in the exam. Probably, I don't know. It's not a good sign. If you know what you're doing, that's the least of your focus. That should be the least of your focus. That this has to come first. This has to come. Me, I won't even do the cover page first. I did not do it first. Probably do it. I might not even put it there, sir, because there is no even mark for that. You don't award mark for that. 0 mark. What is important they have stated it in your question, is one, your appendix, extremely important. Yeah, that was where I would start from. My planning, everything I want to do would be my first page, my planning, all the workings I want to do, the points. That's my first, what I want to do. My workings follows immediately. Immediately I start writing my report. Then when I've written my report, I will structure it so well, which is what I want us to focus on. Not, you are focusing on the wrong thing. Then finally, I'll go and write the executive summary, but at least my executive summary, I'll give it minimum of 30, 40 minutes. Wherever I've gotten to, as soon as it's 40 minutes to the end, I'm going to my executive summary. It's what I'm writing last. So whether it's coming first, whether it's coming last, why are you focusing on that? What is going to give you extra mark for that? Now back to the main thing, your report. Structuring it based on requirements. Now, your ability first is the examiner, to a large extent, he told me exactly what they want us to write because I'm soliciting for government support. I want to justify to the government why they need to include this industry in their policies. I will tell them if they don't know where this industry is coming from, the historical context. I will justify why we need government support. All these data, some of them are inside my precinct, and I will tell them the incentives that we need. Okay, so the one BC was saying, he saw somewhere analysis, implications, doesn't really apply even every time. Depends on what they're asking you to do. So, and I deal with the expected outcome, then I did my conclusions, call to actions. So for me, in each requirement is my ability to subhead and be able to use the data given to me in the precinct. Your ability to understand the problem and provide solution and use your judgments. That is how you pass case study. You cannot learn your way out of it. It's not possible. So the mindset I'm creating for you is a mindset, your ability to think on your own, but I'm guiding your thinking with all of this. I'm guiding it. So in each requirement, your subheadings is critical. Usually you start from an introduction that will set the ground running, that this I'm writing is for this, and this is what I want to achieve. I mean, the cocoa processing has potential to become a major driver of economic diversification, job creation, foreign exchange earnings. However, without targeted government intervention, we cannot achieve all that. Then I spoke to where we were coming from when we were doing well to where we are now. Then I started that, you see, this industry is it deserves your support for these reasons. You can diversify your economy from oil instead of relying on oil. It can create employment for people. It can add value. This process, instead of selling raw materials, you can convert, you can process it to finished product, and you are going to earn 300 to 500% earnings, more earnings in foreign exchange. Import substitution. So over 4 billion worth of related products are imported annually. So instead of importing, if you are producing it locally, that's import substitution. You will not import that item anymore. And of course, with all of this poverty reduction, you can create more points. If it were you should have read this my reports and created more points. That's what your attention should be on. Created more points. How to justify why government should support an industry. You should have Googled it and say, okay, let me have 5 more points in case I forget some. And we talked about exactly what we wanted. That shows that, okay, this guy he's using his judgment. This is what we want from the government. Tax holidays. They should not tax our initial investment. They should wait till when we are making money. They should give us 3 to 5 years tax holidays. They should give us low interest loans at single digits so that it can address the issue of working capital shortage that currently prevents processors from purchasing sufficient raw beans, and which is also affecting the ability to pay farmers, straining relationship with farmers. Export expansion grants, infrastructure investments. They should invest in infrastructure so that it's easy for them to move. Duty waivers on import. When we want to import equipment that we use, they should waive it. Quality certification subsidies. There are a lot of certifications that need to be gotten in order to meet international standard. You can subsidize it. Government should buy from us first. Local content first. And more. I told them that several barriers currently hinders this sector. Outdated technology can be addressed through duty waivers that we have mentioned. Poor infrastructure requires targeted government investments in cocoa growing regions. Limited access to financings can be solved by the single digits interests. Inconsistent quality control can also be solved by the subsidized certification costs. The competition from the more advanced processors required export incentive. They need to encourage their own people so that they can compete at the global market. So if all these are done, what will happen is that it's going to deliver measurable results. Domestic processing capacity will increase drastically. Jobs will be created. Export earnings would be generated. rejection of our product in the by the international market to be reduced. Foreign investment would be attracted. Strategic alliances would be possible. Farmers' income would increase. So from all of these recommendations, I let them know this is what will happen. So in your mind, I have a sequence. Like I firstly laid down where we are coming from. I made them see, guys, this is the problem, right? But we can solve it with this. This is what we need. If you can do this for us, this is where we would be. This is where we would be. Then I then gave a motivational speech at the end of the day, right? That, see, this industry has unrealized potential. History tells us that with the right policy, we can do well because this industry was once a global leader. We can become a global leader again. If you can include this industry in your national development policy and prioritize this sector, you can establish a fund at single digits loan for farmers, for processors, giving them 5-year tax holidays, subsidizing their certification costs, accelerating infrastructural development. We will do well. This sector is at a tipping point. It's either we go up or we die. With right support, we can regain our position as a leading cocoa producer, not in Africa, but in the world, moving from raw material export to value-added processing hub. That's it. Sequencing my solution, my recommendation to the government from problems to solution. Now, that's requirement one. What this does for you again is that it gives you a good idea as far as the problem this industry is facing, the opportunities this industry can provide, what this industry needs to thrive, right? What they need to thrive. Now, the second one is reviewing financial statements. So this financial statement analysis that we need to do. Please give me 1 minute. I need to get to the restroom. Yeah. So now the second one, where the question asks us to review financial statements. Where the question asks us to review financial statements. Again, I started from my introduction. Then I moved to I analyzed profitability ratios, liquidity ratios, efficiency, solvency and position. Then I moved to my recommendations. That in your main body is you need to have that at the back of your mind in every of your requirements. You introduce, like here, I said, an introduction is just what you want to do. That this section reviews the draft financial statement of Sadeco from 23 and 24, taking into consideration the additional information provided. The review covers profitability, liquidity, efficiency, solvency, and material adjustment. Detailed calculations are presented in the appendix. You don't miss it. The guy would happily give you a tick. Then systematically move to your analysis. Simple analysis, otherwise you'd. So let me just go through profitability with you. I started with the trend that revenue fell by 39% from 161 to 98, whatever the figure is, but that. I now linked it that this decline is related to the fact that there is quality control procedures which has affected two large shipments with a value of around 42 million. And also, there is a shipment of 500 metric tons of cocoa butter that was rejected by EU due to pesticide residue. And also this. Now, what I'm trying to do here is my revenue declined, and I linked this to those rejection that we had in the international market. Because they told us in the case, they told me in the case that it's affecting our turnover. So I need to speak to that. That's analysis, because it's when you know what the problem is, you can link your numbers to the problem. My gross, this one is a gross loss. It worsened from this to this, from 14.5% to 45%. Okay, so this means that in the current year, the company is losing 45 kobo on every sales. And it's explained to us that the processing plant the company is using is obsolete, resulting in frequent breakdown, resulting in inefficiency and lower product quality. Frequent breakdown increases repair costs and reduce output, driving up my cost of sales as a percentage of revenue. I don't know if you would be able to do this in the exam. If you cannot, I've already done it for you. This is it here. Use this to learn the linking in the exam. I've already linked it for you. And you will definitely do ratios in the exam. So you need to be able to link these things together. Net loss for the year doubled. So after incorporating adjustment from Exhibit 8, by including impairments and all this, we saw that our losses doubled, became 640 million. This is 650% of revenue. And I said, the company is a loss, is loss making, and the losses are increasing. And the reasons are product rejection in international markets, plants breakdown due to outdated equipment, management overriding quality control procedures. When you are analyzing is not just writing long stories. Analyzing is using your numbers to identify problems. And at the end of the day, you recommend solutions. That, these guys are doing well. This is the reason you guys are doing well. This ratio is bad. This is the reason this ratio is bad. That's analysis. Then I moved to liquidity. The ratios I computed, I did current ratio fell. And I said the company has only 12 kobo of current assets for every 1 year of current liabilities. So it identified this is because of the delayed payment from customers, which is a key factor that is straining their cash flow. And also, the company has been inefficient with inventory management, with excessive inventory level that is tying up capital. Also, still I'm talking about liquidity. Current ratio is bad. Quick ratio is I don't need to start worrying myself around that. I moved to their cash. It fell from 3.3 to like 100K. Fixed deposit is now 0. It's fully liquidated. And I linked it that this is arising because of the company is grappling with severe shortage of working capital due to delayed customer payments, high interest rates, outdated plans, inefficient inventory management, and a poor financial planning. The liquidation of fixed deposit confirms that the company has exhausted its liquid reserves. It does not have money again. Now, these are issues, these are problems that I'm identifying from my analysis. Now, bank overdrafts increased from 3 million to 24.9, an increase of 730%. This confirms that the company has breached its bank covenant, requiring a current ratio of 1 year. The bank has not been notified. The overdraft increase is a desperate measure to fund operations as working capital has dried up. Quick ratio fell. From this becomes negative after adjustment, after writing off. Yeah. Now, the next most important thing is my conclusion. The company is critically illiquid. The causes are delayed customer payments, inefficient inventory management, poor financial planning, bank overdraft is maxed out, and the company cannot meet its short-term obligations. So, see, what you are trying to do with all of this is that you are structuring problems. Yes, they have given you problems but now you are structuring it based on your professionalism, based on the tools, like ratios that you have computed. You can identify which one relates to liquidity, which one relates to profitability. So have structured all the problems. I'm laying the foundation for my recommendation. So I've known why this company is. I already established that they are critically illiquid, and I know why. I've mentioned it, and it's evidential in their financials and in the ratios computed. Okay. Shimamaka, please go ahead with your question.
As what you said about the bank covenant, that's something that is not particular to this case, right? It's a general thing.
So we should remove it. Is it a question or an addition? I'm not getting.
Like, can we write an example the way you wrote it here?
Which one? The bank overdraft?
Yes.
Why not? It's a problem that they have also. Are you talking about this paragraph?
Yes, when you said that the bank requires correlation of 1.0, that's the general rule, right?
Oh, okay. Okay. No. I get what you're saying now. I didn't hear you before. It was in the unseen. The reason why I recalled it because they gave us in the unseen that the bank requires a 1.0. It's part of what they told us. If they didn't tell me, I won't really bring this in.
Okay, thank you.
Yeah. It was because it's there. That's why I'm using it here. Now, the same sequence is what I followed for efficiency ratios. I spoke about my inventory in days, receivable in days, payables in days. I cannot possibly read all of these things to you. I just want to align your mind from your ratios, explain it with the data you have in information. So use your ratios to identify the problems. That's analysis. Use your ratio to identify the problem. The same thing for solvency. I was linking it And this is what Shimamaka was talking about. If you read our Exhibit 8, they told us that the loan agreement requires a current ratio of 1.0, and which we have breached and all that, and we have not notified. So that's why I use that. So with this, now, after that section, I then do my recommendation. This is extremely important because your ratios that you compute might indicate why they are facing what they are facing. And it could be the reverse. It could be that they are doing well, depending on the numbers they give you. If they are doing well, you state it, but this company is not doing well. Their ratio is going to be bad. So very importantly is your recommendation. This gives you plenty of ticks. So your analysis is linking your tool. Your tool should identify the problem. So that's why the examiner gives you a lot of mark for using the data. You're using the information you have, not using it word for word, but structuring it. Structure, like we have done here. Now, our recommendations, I structured it in phases. I said immediate action, seek equity. Seek equity. Because these guys are in negative of at least $1 billion from existing shareholders or new investors. And this $1 billion is just so that we are over whatever it is that is the liability, just so that we come back to positive. And this is consistent with the strategic direction, which mentions seeking equity investment from private equity firm or strategic partners. Notify the bank of the breach immediately and negotiate a waiver or restructuring. Failure to do so, risk loan recall and all that. Also, they need to pay outstanding salaries to prevent further staff from resigning, because they already told us that some staffs are leaving, people in quality control are leaving, people in production are leaving, our key people are leaving. So this is the first thing this guy has to do as far as we are concerned. Yeah. Shamaka, please ask a question.
I wanted to ask last week concerning the equity. Yes, we know that they are going to require equity, but then the equity has come from somewhere. So the people that are coming to invest in the company, considering the dire state of their financial, how are you going to convince them that they should invest and that their investments will yield returns? Or is that something that we're not going to consider when we're answering?
Yeah, so she said, who is going to invest in this company because of the dire situation? See, we have identified it. The truth be told, it's difficult to convince anyone to invest. But the key requirement is that, does the company have potential to grow? Yes, it does have potential. Do we know the problem? Yes, we know the problem. We know that sourcing materials is problem to us. Do we have a strategic direction? Yes, we have a strategic direction. You will get equity if you can pitch properly, right? You will get equity if you can pitch. And why are they losing revenue? We know, don't we? We have already identified that in our ratios. All of these problems, we are going to tell the guys, tell our investors that this is the problem we are facing. If you can identify the problem and you know your way forward, people will invest in you. They might just need to sack 1 or 2 people. Do you agree with me, Shimamaka? What do you think?
I understand what you're saying, sir, but the plan does not equal um actual evidence or results, because there is still the financial statements that you have to show. That's physical numbers that you have to show to say, okay, this is this is what could happen. Which is why I was wondering about the reconstruction aspect. Because you have to show evidence, like financial evidence, or back up your claim. Even if there is potential, how do you know there is potential for sure? Because even the industry is also facing major problems. That's what, but I understand what you're saying.
Exactly. Except if you are saying the company should shut down, that's still what we have to do. We still have to find a way to raise money. We have to raise money. So that's another thing entirely. So investors look, investors invest in companies that have not even raised any revenue. People invest in them. So how much more companies that have started have a track record of progress, but as a result of the macroeconomic issues that they are facing, the industry risk, also the fact that interest rates are high, they can't raise loans and all of that. They can't source materials and the rest. They are facing challenges. We need to try our luck, and that's the first recommendation. That's one of the first things they need to try to do. Otherwise, the problem will still be hanging. They don't have money. Their money is zero right now. Without that, they can't do anything else. Yeah, Uthman. Uthman. Okay. Can the next person speak? Yetunde.
Hello, sir. Sorry, I was
Yeah,
struggling with my system.
Okay.
I'm taking it off from what Chiamaka said. I think we can come up with a scheme of arrangement, because if we see the money this company is owing, if we look at it, there is every possibility that even the bankers cannot recover their money and their interest and their principal. So maybe we'll do a scheme of arrangement whereby we bring them into the game to do like a debt equity swap in a representative manner, such that given time, the company will come back into life, and as the company begin to make progress, and the company is able to address the quality and certification issues, sales revenue will come back, and the bank stands a better position of earning back their interest and their principal, as a recommendation.
Okay. Thank you very much. I agree with that. So the bottom line is equity injection, whatever name you call it. Equity injection. I deal with simplicity. Scheme of arrangement, scheme of whatever. Equity injection. That is the underlying thing. Equity injection. So you can also write that in the exam. So hopefully the guy will get what you're saying. Okay. Another question. Pelumi.
Okay, so if we're doing this equity injection thing, are we going to have to do like a reconstructed statement of profit or loss or financial position to show that if money comes in, this is what the future of the business would look like, or we don't need to do that?
You don't need to do that.
Okay.
You're just making
Thank you.
recommendations there. Yetunde, I can see you and ask a question now.
Okay, sir. I just want to confirm that if peradventure in the exam we see the unseen, can we link the present back to the unseen, as in our report? They make reference to present that, okay, exhibit 2, exhibit 3, this is what happened, both in the case of the golden era and the decline era. I don't know if you understand what I'm saying.
Yes, now, so which is what, if you have been following, which is what I've been doing in my report here, because the pricing has given me a lot of data. Yeah, it has given me a lot of data. So I'm able to use those data, which I identify as problems, to speak to my numbers. So I computed some ratios, inventory, and I saw that it's bad. Then I said, okay, and this is because, this is because my ratio is not good. This is because of inventory management system, excessive inventory, and all of that. Definitely, that is what you have to do. You must do that. That's why they give you everything. I think, was it somebody that was saying, these guys have given us the problem, the solution? I was looking. You have to use them. You have to structure. You go and check the very first page on what gives you mark in the exam, your ability to structure problems. All of those problems, if you don't structure them and use them in your reports, because you need to use it to explain. When you do your ratios and your ratio is going south or north, is those things you will need to, this went this way because that your because is not something you want to generate. It's already given. But when you are making your recommendations, right, then also some of your recommendation might be from there as well. But you need to also structure your solution to the appropriate problems that are identified, and you can also use your judgment to come up with new ones as you wish. Like this equity injection is there already. It's part of their strategic direction to manage working capital. It's the number 2 point there. So it's not new. It's not novel to, I did not invent the solution. I just tapped from there. But I know that the issues they are having with liquidity, profitability, without money, they cannot go anywhere. However, they want to pitch to their investor. Without money, they cannot go, because how do they want to pay their employees, people that are leaving? How would they want to deal with the issue of the bank listing that they're already breaking? They need cash flows. So it's a recommendation. It's one of the recommendations first. Now that's in the immediate. Then when they have money, then they can implement strict capital management policies. They should find a way to aggressively collect receivables, reduce inventory to 60 days or less, negotiate with suppliers to avoid further relationship damage, conduct full investigation into the inventory thefts that's happening, and implement security controls. Engage legal counsel to assess suppliers' lawsuits and the EU importer claim with a view to settle or defend. That has to be, all those mess has to be cleaned up. We have to clean it up. We cannot leave it hanging. In the medium term, they need to do evaluation of their PP to confirm the impairments. They need to implement a quality management system to prevent future product rejection. So this is part of the precise strategic direction. And they also need to develop a turnaround plan with a realistic financial projection and monthly monitoring against target. So you need to have how you want to move to profitability. So the reality is that for me, as a guy that is teaching you this, and maybe some of you, I've seen this happening in real life, because me, I'm a consultant. This is what I do in real life. I have clients facing issues like this, maybe not in the cocoa processing sector, but other clients that, but when we see their account, is in negative. One just raised, that one had to raise further debt because he was unable to raise equity. He had to raise further debt, but the first solution, guy, get money. If you don't get money, unfortunately, he had to lay off staffs. He had to reduce his costs because he was doing close to 50 million in staff costs every month. And what's your revenue like? It wasn't moving so well. So first was we helped him streamline his costs first. And we told him that your burn rate every month cannot be more than this amount, so that he can give you a runway of 1 year. And within 1 year, you need to move to profitability. We structured a working capital management plan for him. There are some people that are owing them that are not paying. So all these recommendations are from real life solutions that you can also apply in this, which is what this examiner wants you to do anyway. This is not a theoretical exam. This is a practical exam, as it were. So, but we're trying to link it to what's happening in this situation. Like here now, if you look at this paragraph, what they need to do in the immediate, they need to, if they don't sort out all of this, they will still be in trouble. People are stealing their inventory. There is lawsuits here and there. They need to resolve it. They need to clear all of those mess. If they have tax liability, they need to clear it. And they are starting in a clean way. The impairment issues, why is impairment coming up? Because according to IAS 36, are they indicators of impairment? Have we seen the fact that market prices have gone up? Did we abandon the asset? So what's happening exactly? We need to ask an independent valuer to get the recoverable amount. Again, the rejections, we need to work towards it. That quality management system is a must do. Okay, so without wasting too much time on that, that's requirement 2. So this will help you greatly in your exams. Now, the strategic alliance, the calculation we did, again, look at me. I started with the introduction. I summarized the alliance, the financial projection and key assumptions, and also the calculations we did, the results of the IRR and the NPV, and the failure of the project, because this project failed, it's not working. Then the sensitivity analysis, how sensitive it is. Then I linked it to, then I gave my recommendations at the end of the day, what they are supposed to do. And also, I spoke about the requirement 4, which is governance and ethics. Again, introduction. I spoke to governance. I spoke to, these are all the issues around governance that are in the cuisine I spoke to about. You can just look at it. And of course, I always recommend solution, what they should do. Then ethics, I identify the issues, what's the unethical issues going on within the organization, what they should do, the actions they need to take to stop that. So all of these were issues that are raised from the unseen, and I recommended the way forward for them. And ultimately, I spoke to sustainability, that they need to operate and integrate sustainability into the proposed alliance. So they need to get sustainability certification, implement traceability system, right? They need a system where they can trace where their raw materials are coming from. They need to train farmers to be sustainable, invest in renewable energy, eco-friendly packaging, and they need to publish sustainability reports, especially now with the ISSB, with their singular framework that they have brought. It makes regulatory compliance on sustainability reporting easy. Then you might not, I just summarize key findings. You might not have the luxury of time to do all of this. Then I concluded with my recommendations on all of that. And at the end of the day, I'm now ready to do my executive summary. And my executive summary, again, what I want to do, what I want to write about, right? You see the introduction. This report responds to the board request for advisory service as the company seeks to implement on our own strategy. It covers 4 key areas. I mentioned it. And the findings are based on the materials given to us, and also the statement of financial position and the strategic alliances. So what I want to write about, the data I used and all that. Then the key findings in my report, summarized it, and I did mine based on requirements. From requirement 1, I told them what I told the government, that they need to implement 6 policies. I just listed it fast. And I told the government that this industry has significant potentials. I just summarize what I wrote there. The same thing for financial statement review. I summarize profitability, efficiency, and all of that. That the company is in financial distress, revenue fell, liquidity is critical, efficiency is poor, solvency has collapsed. I summarized the key thing. The same thing for strategic alliances. The fact that the NPV is negative, the IRR 20% cannot be achieved, and all that. Same thing for governance requirements. So these are my findings. And also recommendations for each phase that I gave on each of those issues. Then my final statement. So yeah, because it's almost 5. I want to go to the second variation. So I've all of these, you should look at it. But the core of your report has to be linked to the requirement of you structure your reports based on the requirement. And when it comes to ethics, right? You see, the exam might not even talk about ethics at all. They might not ask you anything around ethics. You have to speak to ethics. You have to speak about ethical issues and actions to be taken, whether they ask you or not, because it's 10 marks. It's important. Speak to the issues, actions. Like the issue of quality control, I spoke to it. Why is it unethical? Because it's placing consumer at risk and all of that. And they need to conduct an immediate investigation and sanction the regional manager. Implement a policy that quality control cannot be overridden. The same thing for supplier kickbacks. So look through it and see how to attend to ethical issues. The same thing for governance. The issues they identify as governance problem in the solution. Even if they don't give me in the unseen, they didn't say about governance, as long as I'm given the board structure, I need to speak to it. Because in all strategic alliances, people invest, companies or investors invest in people. They invest in people behind it. I will only invest in this company when I know that the people running it are capable. So there is no way you would speak to problems and provide solution and not talk about governance. They have the appropriate governance structure to drive that strategic direction you're talking about. So all of these recommendations were given. Can they drive it with their current board structure? So that's why governance is important in every of your solution. Okay, now let me take 1 or 2 questions before I want to move to the second variation. Hopefully the 1 hour remaining would be enough for that, because it might be that one you find in your exam. That's my worry.
Okay, sir.
Okay.
Sorry. Just a quick question, sir. I wanted to ask that summary of that summary you made when you were answering the requirements. How did you make sure that like you did not repeat information?
Which
There was a,
summary? Are you talking about my executive summary?
sorry, if we can scroll up, maybe I'll.
Is it this one?
No, before after all these ones, I think there was a place where you were when you were about to write your conclusions or so, and
Is
you
it
now like summarized the whole. Oh,
so
okay.
in my executive summary, there's no way I will not repeat some things in my main reports. I would, of course, pick the main points there. So after my introduction to my executive summary speaks to what the report is about. I mean, the people that give me job, that they asked me to do this, and they asked me to write about 4 key areas. Also, where I got my data from, all my findings are gotten from the data given to me, my research, the pre-seen material on scene, and the financial statement, and also the data they gave me on their turnaround strategy, the letter from the data that I used. Then my key findings. There's no way I won't repeat now because it's everything in my main reports that I'm summarizing here. So my requirement one, I told them that I'm trying to convince the government to include us in their national development plan, making them see that this industry has significant potential to drive economic diversification, job creation, and foreign exchange. We used to be leading, but now we are doing bad. We requested for 6 incentives, policy incentives to be included, which I mentioned. And if they're able to do this for us, the industry will be able to generate employment, import substitution, and all of that.
Okay, sir.
So
Yes,
that's
I
the main
understand.
thing.
It's
Yeah.
like using the information to cite what you are explaining or something. I get you.
Yes. Yes. So what I have in mind in writing this is that if this guy should read it, will he understand my reports very fast? So in my two, I spoke to each of the major headings and I was just key. I spoke about revenue. I told them that revenue fell because the gross margin also worsened. Liquidity is critical because current ratio fell. So I didn't have to start explaining what when I was talking referring them to all this pre-seen in detail like I did in my report. Yeah, I was saying okay, liquidity is critical because current ratio fell and fixed deposits efficiency is poor because payable in days have increased, solvency has collapsed because equity is negative, like that. It's just the main points. The strategic alliance too. The alliance is not financially viable. The project has a negative NPV. The target cannot be reached. And the reason is the displacement effects and all that. And the fact that we have to redirect 40% of our materials and move to. So the guy is reading, he understands what I've found out. That, okay, yeah. And my recommendations too. I spoke to him. I know I really have to do this table. Just you can pick key points from your recommendations and run with that. Then at the end of the day, you make your conclusions or final statements. Then you're done with that aspect. Okay. So while every other part of what we have discussed so far stands, in terms of requesting for government support and the justification we gave to the government, in terms of our ability to analyze whatever financial statement you are given, right? Or the adjustment you might have to make to the financial statement, and also while those other ones stands, what might change is the strategic alliance. They gave us 2 strategic alliance or strategic direction, in the pre-seen. Is either you're doing backward integration or you're doing strategic alliance. So the examiner can come from strategic alliance or backward integration. Or you might ask, or they might give you the 2, you're going to be comparing, which is better. So which is why I'm giving you this second variation, which is backward integration. So what I've done between last week and now was to look at what can happen for backward integration. From the pre-seen, they gave us 2 options in the pre-seen. They said it's either you go and acquire a farm or you partner with farmers. So I just want to compare the 2 very fast. So I'm replacing that Exhibit 9 with this. It says Sadeco Cocoa Processing Limited, backward integration data. Hey, Pelumi, can you read this, please? Just give me 1 minute. I want to attend to something. Come in.
Should I read or should we wait for you?
I think you should wait for me.
Okay.
Pelumi, we can't hear you.
Because I was not saying anything. No,
You
I
thought
want
we
to
should
start
wait
talking.
for him.
Yeah. Okay, I'm back now. So it says Sadeco Processing Limited backward integration financial data. The board has approved management's proposal to evaluate two backward integration options as part of the company's turnaround strategy. As referenced in the preceding, option 1, farm acquisition. Acquire an existing 2,000 hectare cocoa farm in Ondo State. Option 2, outgrower scheme. You partner with 2,000 smallholder farmers through a cooperative outgrower scheme, providing training, inputs, and financial support in exchange for a guaranteed supply. The financial data for both options is set out below. So, initial investment, option 1, if you want to acquire farm, is it 100 million? You rehabilitate the farm, 200 million. Farming equipment, 100 million. Training, 20 million. Inputs or seedling and fertilizer, 30. Working capital, 50. Total initial investment for option 1, 1.2 billion. But if you partner with farmers, you don't need to buy farms and all that. But you will need to train them. You will need to provide them with seedling. You will need working capital, 300 million if you partner with them. So annual operating result from year 1 to 5. So if you are the raw materials you get in option 1 the same outputs. In the exam might be different, but let's say the same. Cost per ton. This is 250. This is 200. Because this you're doing it yourself. These guys are the experts there. The total annual costs is 250 times this 4,000. While the total annual cost for option 2 is this. The market price is 350. That's the market price. That is, if you are going to buy it outside, it will be this. Okay, for each of these raw materials per ton. So the annual benefits, okay, is 1.4 billion. That's the annual benefits, and the annual benefit here too is 1.4 billion. So the net annual benefits is this 1.4 billion minus the costs. So they give us the net annual benefit, which is the savings minus the costs, is this. Well, this one is 600 million. So additional quality benefits. So rejection of our products, estimated reduction in rejection is 50 million option 1, 50 million on option 2. So that's additional benefit for us. In addition to this benefit that we have here, so we have a total net cash flows of this. The residual value of the farm at the end of the 5 years, since in option 1 we are buying a farm, is 600 million. We are placing value on the relationship we have with the farmers now, 100 million. So those are the numbers given to us in the unseen. Then they give us some assumptions that market price of 350,000 per ton represents the costs the company saves by not purchasing cocoa beans externally. So they are explaining that this market price is that if you didn't partner with these people, if you don't have your own farm or farmers that are working for you, you will have bought it at this price. But because you have your own farm, you'll be getting it at cost price. Okay, so That's the market price. They said quality benefit of 50 million per year represent estimated reduction in costs related to product rejections, storage, handling, and reputational damage as referenced in Exhibit 10. 3. The project horizon is 5 years for both years. The board requires a minimum IRR of 20%. The company will finance the investment through equity injection as recommended in requirement 2. All cash flow occurs at the end of each year, except the initial investment, which occur at the beginning. Okay, so this is now the adjusted requirements. Evaluation of proposed backward integration strategy. The board of Sado Processing Limited is considering 2 options for backward integration as set out in Exhibit 9. The board requires a comprehensive evaluation of both options to determine which, if either, should be pursued. You are required to do a financial evaluation, calculating the following: initial investments, annual net cash flows, NPV, IRR, payback period, undiscounted. Sensitivity analysis. For each option, perform sensitivity analysis by varying the following key assumptions by plus or minus 20%, production volume, market price, cost per ton. For each variation, recalculate NPV at 20% and state whether the option remains viable. Identify which option is more sensitive to adverse changes. Comparative evaluation and recommendation. Compare both options against the following criteria. 1, financial viability. 2, capital requirements relative to SCPL current financial position. 3, risk profile based on your sensitivity analysis. 4, strategic alignment with the turnaround strategy described in the present. 5, ability to address the quality control issues raised. Recommend which options the board should pursue or whether neither should be pursued. State any conditions or modifications to improve viability. Finally, linkage to present challenges. Explain how your recommended backward integration option addresses the following challenges documented in the present. 1, inability to pursue sufficient quantities of raw cocoa beans due to working capital shortage, poor quality control leading to international product rejection. 3, damaged supplier relationship with cocoa farmers. Okay, so that's the variations that I bring forth to you, and it's quite direct. Okay, you don't have the mindset that this is you. I've already done the report, I've already done everything for you. All you need to do is just to take your time and read the reports and understand it so that in case of any changes in the exam, you would be able to attempt and do the right thing in the exam. Don't forget, the mission is you don't fail. You cannot fail this exam. It will sadden whoever has taken so much effort to teach you. So for this guy, I'm just following the trend that's given to us in the present that the examiner might want to give you these options too. And these are the numbers that would back up each of this. You need to be able to assess it. So the requirements in your exam will not be this much. It won't be this lengthy. But I'm just giving you a lot just so that wherever it is coming from, you can do something or you can relate whatever knowledge you have gotten here to whatever it is they are going to be asking you, right? And as always, the first thing you do is your calculations. Okay, so you calculate for option 1 and for option 2. So for option 1 now, from the data given to me, my total initial investment, they gave me, this is the total cost. They also gave me the money I will get, my inflow. And also, year 5, they said I will also get the farm will have a residual value of 600 million. So my total net cash flow is 1,050 million. So the summary of cash flows for option 1, the initial investment is 1.2. Year 1 to year 4 is 450, while year 5 it is that 450 plus residual value. Then with the cash flow now, I can compute my NPV using a discount factor of 20%. So if I discount each of these cash flows using 20% discount factor, my NPV comes to this. It's positive. Now, my IRR, right? I told you that the higher the discount factor, the lower my NPV. So I used 2 or 3 tests just to, so I just intentionally, I can use 30% first, but I used 25%. I recalculated the NPV. You see that it reduced. I increased it to 30%. It reduced further. I increased it to 32%. It reduced to 5 million. When I increased it to 33, it became negative. So I'm sure the NPV the IRR that would make my NPV to be 0 is going to be between 32% and 33%. So it's between these two. So approximately this, like that. And there are formulas for it also that you can use to determine it, like lower rates plus the bracket NPV and lower rate minus NPV and higher rates. I'm not giving you those formulas here. So now, then I did my payback period undiscounted. In year 1, outflow of this, so cumulatively is this. In year 1, inflow of 450. So it reduces my negative to 750 million. Year 3, inflow of this reduces my negative to 300 million. Year 3, inflow of this, now I'm in positive. So that means I've recovered my investment even before the end of the 3rd year, because at the end of the 3rd year, I'm already in positive. So I did 2 years plus 300 over 450. So I got around 2.67 years as payback period. Option 2, the outgrower pro scheme, where I partner with the farmers. I train them, I give them seedling, I give them working capital and all that. So for this one, my initial investment is 300 million. My initial investment is 300 million. My annual net cash flow is 650 from year 1 to 4. When I add the residual value for year 5, it becomes 750 million for year 5. So this is my summary of cash flows. Year 0, outflow. Year 1 to 4, 650. Year 5, I include the residual value, becomes 750. My NPV, I discount the cash flow at 20%. Is 1.6 billion. My internal rate of return, when I try different rates, the one that gives a negative was when I tried up to over 200%. So my IRR is between 215 and 218%. It's going to be between those two. My payback period is within 1 year. It's less than 1 year, because my first inflow is 650. It's already higher than my outflows. So doing very well. Then the sensitivity analysis. So they asked me to vary some variables between plus and minus 20%. I think they asked us to vary the volume, the market price, and the cost per ton. So these are the base cases before sensitivity. The production volume was 4,000, market price 350, cost per ton 250, margin is 100. This is the benefit he's getting, because if he was going to buy it outside at the market, it's 350, but because of the relationship he has, because he has his own farm, he's able to obtain it at this, so he's getting a margin of this. So from all of this, he's getting a benefit of 400 plus the quality benefit is a total of 450. We already did this before, so this is 1,050,000. Initial investment, this. NPV at 20%, this. IRR, this. Variable, yes. So the project is definitely variable. So let's vary it. Let's do sensitivity for production volume first, for between plus and minus 20%. So this is the base case. From the base case, my margin is 100. My net cash flow is this per annum, 450 per annum. Then 1,050 also as my year five cash flows. If I add the residual value, then if I reduce the volume by 20%, that's 80% times this. The volume becomes this. Then my annual benefits is 100 times 3.2 plus the quality benefits. If I add it to 320, it's 370. If I then add 600,000 residual value to this, that's 970. So if I increase it by 20%, that's 1.2 times this. So we have 4.8. So it brings up my year 5 cash flow to this. One, my annual cash flow from year 1 to 4 is this. So using this cash flow for the variations, for minus 20, using the annual cash flow of 370 and year 5 cash flow of this, if I discount it by 20%, I still have a positive NPV of 147. Remember, this is option 1. For the increase, if I use my annual cash flow as 530, my year 5 cash flow as this, I still have a positive NPV of this. So not bad. The same thing for the market price. This is the base case. If I reduce, the market price was 350. So if the market price reduces by this, so my margin is only 30,000 because the cost is 250. So the margin I'll be getting is just 30,000. So my annual cash flow becomes this. My year 5 cash flow is this. If I increase the market price by 20%, then my annual cash flow becomes this. Year 5 cash flow becomes this. So if I do NPV on that as well, it gives me a negative NPV for a market price. My market price should reduce by 20%. So year 1 output, the initial outlay, the annual cash flows, then year 5 cash flow, negative NPV, using these cash flows. If I use the variation where my market price increases by 20%, which is this, I still have a positive NPV. Okay, I'm coming. Then the cost per ton also, if I vary that, this is the base case for the cost per ton. If it reduces by 20%, which is 200,000, then my margin becomes 150 because the cost was 350. And if my cost should reduce to 200, then I'll be making a margin of, well, the market price was 350. Is my cost should reduce to 200, I'll be making a margin of 150. Then this is the resulting cash flows. If I increase it by 20%, these are the resulting cash flows, the same explanation. If I then compute NPV for reduction in costs using these cash flows, I have a positive NPV. Increment in costs, I have a negative NPV. And I do the same thing for the outgrower program. The same, if you understand that one, is the same sequencing for this one too. So I just change, it's just the cash flows that are changing, the same explanation for this. And that is the whole of my workings. Okay, Balumi, you can ask your questions now, please.
Okay, thank you so much. To start with, if the question says to calculate if the project is viable or something, would that one do NPV or the IRR? First of all, must we calculate sensitivity analysis? And yes, if we must, I'm thinking, can't we just, because I feel like I understand it better through the SFM routes that just says that sensitivity analysis is the margin to which, if any of the, tolerable extent that any of the variable can change, to which NPV is going to be negative, which we just have simple formulas. For example, if you want to calculate the cost, maybe like a particular cost, just the NPV of that cost, the total NPV all over the production cost, for example, will give you the percentage to which the cost must not rise above. Can we use that logic and that format? And also for the sales to also give you, if you calculate the NPV all over PV of sales, to tell you the sales must not go below this point, else the project will no longer be viable. And same for project life, cost of capital, we know how to calculate those things. So can we use that format instead?
Okay, so your first question, if they ask whether the project is viable or not, must you calculate sensitivity analysis? No. Okay, so in recent diets, we hardly have to do that. We hardly had to do that in most cases. It's been a while that has been asked. So do you have to calculate it? No. Can you use other ways of determining your figures? Yes. Yes, 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 yes. However, how easy it is that you can walk through around this is yes. So all I'm just doing in my own case here is just I'm just minimizing formulas. It's not everybody that is doing SFM. So I don't want to start dealing with, so that's why I'm being expressive. That's why I'm being expressive. You know the formula because you are doing SFM. If you are not doing SFM, you will not know the formula. So that's why I'm introducing little or no formula in every I'm just doing simple analysis. And in real life, a lot of us don't even remember this formula in real life, except I just want to go and check it. I use expressive calculations to get whatever it is I want to get, not formulas really.
Yeah,
right?
thank you
But
so much.
yeah, but can you use it in the exam? Yes, of course you can. You can. Must you do sensitivity? No, you don't have to, except if it is specifically asked in the exam. Any other questions?
And sorry, this might sound a bit like a petty question. Just to have an idea, how many pages do you think one has to write? Because, I was going through executive summary before the class and I'm like, executive summary is what are we even writing? How many reports? I don't know. So, you know, there are some that you just have like, this is too less of a page. I mean, this is too less number of pages. Like, what do you think? Must your paper be full? Must your, you know, just, I don't know, maybe it's the right question, but just to have an idea, like how many pages are we looking at for this whole thing?
It depends really. I think you need to focus more on the process rather than the results. So if you eventually write 50 pages, if you eventually request for more paper, let it be a result of your process, right? So as far as I am concerned, the process I'm talking about is, as soon as you get to the exam hall, you read your unseen, you see the requirements. First thing that is paramount for us to do is that we need to determine our appendix. We need to do our workings correctly. I don't know how many pages that is going to take you, but do it. And do it within 1 hour. As soon as your 1 hour is complete, you might want to leave it and move to your main report. Your main report should be structured around your requirements. Attack your requirements. It's very, very important. If you don't attack each requirement and you think you have a structure in mind, you would not pass that exam. So structure your reports by your requirements. And for each of your requirements, start with an introduction. Move from the problem to solution using the data given in the question and some further evidence given in the unseen, backed it up by the calculations you have done in your appendix. Your appendix is going to drive how you structure the problems. By the time you have analyzed their books, you have analyzed their data, it will show why they have such problems. It's important you read this report to see how I'm able to link my appendix to their problems. Then I provide solution and recommendation. That is the process. Requirement 1, requirement 2, requirement 3, requirement 4. If that gives you only 4 pages, then that's fine if you have followed those process. Then eventually, you go to your executive summary. Don't forget what I've said today. As soon as you see that you are like 30 minutes to the end, or not even 30 minutes is too small, like 45 minutes to the end of the exam, leave whatever it is you are doing. Go and write your executive summary. It's 20%. He's not joking, no. In fact, if you don't do executive summary, there's high possibility that you will not pass that exam if your executive summary is not done. Then do that. When you're done with that, submit, and they'll be looking. You will pass. That's the process we are talking about. So leave whatever the number of page it results into. Leave that. That's not a problem. So now with this variation that we have now, how do we then vary our reports? So my report is going to change a little bit because, like I always do, I structure my reports based on the requirement, starting with introduction. I will introduce what I want to do. Looking at my introduction, I said, this section evaluates the 2 backward integration options presented in Exhibit 9 against 5 criteria, because they gave us, this introduction basically is just repeating what the question asked me to do, basically. And I'll tell them the detailed calculation is in the appendix. That's basically what the introduction is about. Then I started with the first option, which is evaluation of the option 1, which is farm acquisition. I said the farm acquisition option requires an initial investment of 1.2 billion. It generates an annual cash flow of 1.2 billion it generates an annual cash flow of 450 from year 1 to 5, from year 1 to 4. And in year 5, it has 1 billion and 50 million, including the residual value. At the board's minimum required return of 32%, the NPV is 386.9 million and the IRR is 32.2%. The payback period is 2.67 years. Option 1 meets the board's 20% target and delivers a positive NPV. Secondly, from requirement 2, SCPL has negative equity of 590 million, a current ratio of 0.12, and has breached its bank's covenant. The company cannot afford a 1.2 billion investment. Cannot afford a 1.2 billion investment without a substantial equity injection that is not currently available. So the precinct confirms that the company is struggling with a severe shortage of working capital. So option 1 is not feasible, given that the company is currently faced with financial stress. The third one, risk profile. See, all this heading is based on the requirement of the question. That's how the question said I should evaluate each of them. I should look at the financial viability, capital affordability, risk profile, and all that. Strategic alliance with us. So that's what they asked me to do. And that's what I'm doing. So risk profile. So the sensitivity analysis reveals that option 1 is highly vulnerable to adverse changes. So the base case, yes, NPV at 20% is positive. Market price, if the market price go down by 20%, then the project is not viable anymore. So that means it's better to just go and buy it at the market rather than spend all this money. Cost per ton, if it will increase by 20%, the project is not viable anymore. If the production volume decrease, is still viable, right? In terms of production volume. So, but in terms of market price and cost per ton, no. So the precinct notes that global cocoa prices are volatile. So at 20% drop in market price, a realistic risk in the cocoa industry would render these projects unviable. Similarly, an increase in production costs would also make the project unprofitable. So option 1 is high risk and fails under realistic adverse scenarios. Strategic alliance with precinct. So the precinct mentions farm acquisition as an option. However, it also emphasizes that the company has a damaged relationship with cocoa farmers due to delayed payments. Acquiring a farm does nothing to repair this relationship. It bypasses farmers entirely. So option one aligns with the letter of the precinct strategy, but not with its spirit of building of rebuilding relationships. So ability to address quality control issues. So Exhibit 10 shows that EU importers are rejecting shipments due to the pesticide residue and all that. Option 1 will give direct control over farming practices, which is beneficial. However, because their processing plant is obsolete and the company lacks working capital, rehabilitating a newly acquired farm will take a long time, might not address the issue immediately. So I gave an overall assessment. But option 2, which is farmers partnership, now requires an investment of 300 million, 1/4 of option 1, generates 650 million in year 1 to 4, and 750 million in year 5, including the residual value of 100 million. So at the board's 20% targets, NPV is 1.68 billion, IRR is 216%, payback period is less than a year. Option 2 far exceeds board 20% target and delivers exceptional return. Capital affordability. SCP requires an injection of at least 1 billion to restore. So a portion of this is just 300 million, can be allocated to the Agora scheme. This is feasible, unlike the 1.2 billion required for option 1. Okay. So I said option 2 is feasible here. Risk profile. In all options, option 2 is viable. In all if you decrease market price, it's viable. If you increase costs, it's viable. If you increase production volume, if you decrease production volume, you can get is viable. Does it align with the strategic alignment? Partnership with cocoa farmers through cooperative and co-op is a key component of the turnaround strategy, which is exactly what option 2 delivers. Furthermore, it identifies delayed payment to suppliers, which has damaged relationship with cocoa farmers as a current challenge. So the Agora scheme build this relationship by offering farmers training, input, and all that. So option 2 is strongly aligned with that as well. Ability to address quality control issues. So again, the PRISM recommends supplier development program to train farmers and all that. So option 2 includes 100 million for training and extension services specifically for this purpose. So option 2 directly implements the PRISM. So overall, option 2 is financially viable. So I gave my recommendation. So you can read through this recommendation, because we are asking them to pursue option 2. And we are giving them the reasons from our analysis, and we give them conditions for implementation. We give them conditions for implementation and what they should do and all that. So you can just read through what is remaining over here. And this is the end of the present. I've said everything that I need to tell you. You know everything that you need to know. What is left now is for you to go and read these reports. Get it, read it, understand it, vary it, and be ready for whatever it is they're going to bring in the exam. Thank you very much. Any questions? All right, everyone. Bye. Okay.
Hello, sir.
Yes, please ask your
Sir.
questions.
Yeah, last week you promised that somebody is coming to speak to us on business strategic model.
Yeah, he has sent his material to the group. I will share with you. The guy was unable to make it. So if we look at the materials and you need him to still speak to you, he will come up and he'll be able to speak to the material he has shared it to us on the group.
Okay. Thank you.
Yeah.
Okay, can we private chat you if you have challenges, areas of challenges, please?
Oh, definitely.
Okay.
Definitely. Between now and the exam.
All right. Thank you.
Bye, everyone. All the
Okay.
best.
Thank you so much. Yeah.
You're welcome.